Welcome to the deep dive. Today, we're tackling a really comprehensive view of value investing, one that goes, far beyond just spreadsheets and quarterly reports.
Right.
We are diving deep into the mind of Li Lu, the founder of Himalaya Capital. He's an investor who's celebrated for these spectacular returns and, of course, his very close association with Charlie Munger.
And that association is key. Lilu's success is not some accident, and it's definitely not just because he's a brilliant accountant. He is a philosopher investor. I mean, his entire approach is rooted in this expansive, almost proprietary system.
A system that does what, exactly?
It synthesizes everything. It takes the deep value principles of Benjamin Graham, and it merges them with the compounding growth philosophy of Munger.
Okay, but there's a unique anchor to it.
There is, and it's all anchored in this unique, almost physics-based theory of history and civilization. We're here to unpack what he calls his unified field theory of capital.
Wow, okay, that immediately raises the stakes. We're not just looking at a few investment tips here.
Not at all.
We're looking at an entire epistemological framework, a complete way of knowing the world before you even think about picking a single stock.
Exactly.
So our mission today is to really get the why behind the how. Why does he believe that just owning stocks is justified by the arc of human history itself? And then what are the really rigorous steps he takes to find those mispriced assets when the market is just pure chaos?
Precisely. And to do that, we've synthesized his foundational lectures, the ones he gave across, almost 2 decades, specifically at Columbia University and Peaching University.
And these talks are the key.
They're the blueprint.
Yeah.
They reveal this internal conviction mechanism that lets him stay rational when it feels like markets are just collapsing around him.
And that conviction, it has to be tested against real-world volatility, which brings us to a really crucial point about mindset. As we're discussing, tracking these huge market forces, trying to understand the overall market temperature, it's so important to have the right tools.
For sure.
For anyone trying to develop Li Lu's preservation-first mindset, you can actually search and download the iOS app Buffett Indicator from the Apple App Store. It helps you track the total market cap relative to GDP,
which is a vital gauge of market temperature.
It's a great companion piece, really, for anyone trying to apply this kind of deep value discipline.
That awareness is absolutely key. Now, before we really dive in, a mandatory clarification.
Always.
Everything we discussed today is based on publicly available sources. It's purely for educational purposes. This is not, and I'll say it again, this does not constitute investment advice.
You absolutely must conduct your own due diligence before making any investment decisions.
Okay.
So let's unpack this. Li Lu's starting point is, he sees it as mandatory. He argues that if you don't understand the fundamental economic game you are playing...
You're just gambling.
Exactly, you're gambling, and you don't even know the house rules. He insists we have to move beyond the typical economic models.
Right. Forget Econ 101 for a minute.
And instead, analyze human history through the lens of energy capture and social organization. He calls this the physics of civilization.
And this historical taxonomy, this framework, it provides the fundamental justification for why you, as an investor, should even be in the equity market in the first place.
It's the core conviction.
It's the core conviction that you need to endure the volatility. Because what you're really betting on is the inevitable continuation of human technological progress. And he breaks this down into 3 very distinct eras.
The journey begins, he says, with Civilization 1.0, the hunter-gatherer paradigm. This is humanity's baseline. It lasted for, 200,000 years after Homo sapiens first emerged?
An almost unimaginable amount of time. And the core reality of that time was total reliance on immediate energy acquisition.
Muscle power.
Muscle power. You hunted, you gathered, you consumed. That was it. And because resources were perishable, energy storage was either primitive or just impossible.
The whole system was a zero-sum game.
Or even negative sum, during a famine or a drought. If your tribe secured a good hunting ground, that meant another tribe lost it. It's a finite pie.
And the implication here is just structurally critical. There was no mechanism for compounding wealth.
None.
Accumulating wealth beyond your immediate needs was physically impossible. You lived completely in the present.
Which creates a survival mindset, right?
Yeah.
A very, very short-term focus.
Which changes with Civilization 2.0, the agrarian limit. This starts with the agricultural revolution, and it lasts all the way until about 1700 AD.
And this was the first huge technological leap. Domestication. This allows for the first time, reliable energy storage grain and the division of labor.
Which creates civilization as we know it.
States, cities, hierarchies, all of it.
But, and this is a huge but, this introduces the famous Malthusian trap.
Right. Growth was strictly linear. It was directly tied to the photosynthetic limit of your arable land.
You can only grow so much food per acre.
That's it. So when you had an innovation, let's say a better plow, sure, productivity improved for a bit.
But then what happens?
Population inevitably grows to consume that surplus. And pretty soon, per capita resources are right back at subsistence levels. It's a trap.
This cyclical reality, this constant ceiling on growth, is what forged what Li Lu calls the static mindset.
And he finds this so pernicious. This is a crucial psychological takeaway for him. Because humanity spent, 99% of its economic existence in a world where wealth was a zero-sum game tied to land.
Our cultural and psychological default is that static view.
It's in our DNA, the idea that if I gain, someone else must lose. And that mindset, he says, translates directly into how most people behave in the stock market.
That makes Civilization 3.0. The era of compounding just a radical, fundamental break from all of human history.
It's a complete paradigm shift. This era is defined by the Industrial Revolution. It's where our energy constraints are just shattered.
Yeah.
By coupling massive external energy sources, first fossil fuels, later nuclear power, with modern science and, crucially, free market institutions.
For the first time, energy is basically unlimited compared to that Malthusian constraint.
Exactly. And the combination of that energy with intellectual capital ideas, processes, technology, software, it moves the economy from linear growth to exponential compounding growth. This is what he calls the unbounded economy.
And this is it. This is the vital insight that underpins every bit of Li Lu's investment conviction.
This is the foundation.
The economy is no longer a static, a zero-sum game. It's a positive-sum machine.
Right. And therefore, the stock market is not a casino where you're just betting on price changes. It is a legal mechanism for owning a piece of that continuous, unbounded creation of new value.
So if you hold a quality piece of equity,
then mathematics, history, and physics are all working in your favor. Time is your ally, not your enemy.
So if Civilization 3.0 is the new environment we're playing in, he then introduces the iron law of modernization.
Right, and this is the engine. This is what drives the acceleration and the distribution of that compounded wealth across the entire globe.
He uses this really great analogy to explain the velocity of it.
In Civilization 2.0, traditional trade, it required value A to be less than the price, which was less than value B.
So 1 + 1 is greater than 2.
Exactly. It creates a surplus.
Yeah.
It's a net positive, but it's incremental. You trade your extra grain for someone else's extra iron.
But in Civilization 3.0, the trade is totally different. It often involves intellectual capital and technology.
And when a piece of code or some advanced manufacturing process is shared, it breeds innovations everywhere else. The value created is exponentially greater than the sum of its parts. This is the multiplier effect. 1 + 1 is greater than 4.
Can you give an example of that?
Sure. Think about an open source software library. A team of developers creates it, right? But then thousands of companies use that knowledge to build their own products. The value created far, far exceeds the initial cost of developing that software.
So the iron law statement just formalizes this idea.
It does. It says that the system with the greater trade volume, the biggest economies of scale, and the highest division of labor will have the greater velocity of compounding growth.
And what's the end result?
It will eventually create a single, unified global market.
This has a huge strategic implication, especially today. Li Lu argues that despite all the intense geopolitical tension, the tariffs, the nationalist rhetoric,
the gravitational force of mathematical superiority, the fact that participating in a global market is just exponentially more beneficial than isolation.
It makes globalization inevitable in the long run.
The benefits of specialization and global scale, he believes, will always overcome the temporary barriers we put up.
I have to push back a little here, though. Isn't that analysis, potentially a bit politically naive, or at least maybe it's too long-term?
That's a fair question.
If a major country decides to impose massive, sustained tariffs, doesn't that mathematical superiority grind to a halt, at least temporarily?
It could.
And that could threaten the investment timeline for even the most patient, disciplined investor.
It's an essential question, and Li Lu's answer is really rooted in a kind of historical determinism. He sees these political actions as noise, not signal.
So, a temporary distraction.
Exactly. He believes that tariffs and isolationist policies hurt the countries that enact them far more severely than the system as a whole.
Because they're voluntarily cutting themselves off from that 1 + 14 multiplier effect.
You got it. The speed of global growth might slow down for a bit, But the difference in growth between the open and the closed systems becomes so vast.
That the isolated country eventually suffers.
It suffers severe internal pressure to re-engage with the world. His conviction is that the fundamental physics of compounding growth will eventually force political reality to align with economic reality.
So the investor's job is just to endure the political noise and hold on to the compounding asset.
That's the core of the conviction.
So this macroeconomic conviction is critical. It explains who you're competing against, or maybe more accurately, who is providing your opportunities.
Right. Lilu applies his whole taxonomy directly to the stock market participants. He explains market volatility not as some economic phenomenon, but as a psychological one.
He says 95% of market participants behave as speculators.
And their mindset is rooted in Civilization 1.0, the hunter-gatherer paradigm. They operate under a zero-sum focus.
They're hunting for that immediate price jump.
Yep, they're hoping to sell to a greater fool. They see the market as this finite pool of capital that they have to exploit, and exploit quickly.
And the outcome for the vast majority of that 95% is, well, it's pretty predictable.
They underperform the broad market after you factor in fees, taxes, and their own inherent emotional and cognitive biases.
All of which are amplified by the pressure of short-term quarterly performance reviews.
Then you have the investor, the other 5%, and they operate with a Civilization 3.0 mindset.
They see themselves as part owners of productive assets.
Of a compounding machine. Their focus is strictly on the fundamentals of the business and the long-term flow of cash back to the owners. They're not trading. They're allocating capital based on the mathematical inevitability of that iron law.
And here's where the synthesis gets really dynamic. The 95% aren't your enemies.
Not at all. They're essential.
Their collective irrationality, their frantic zero-sum trading, that's what creates the liquidity. And critically, it's what periodically creates massive mispricing.
This volatility is the opportunity the 5% wait for. The speculator's noise is the investor's signal.
So the value investor becomes the liquidity provider of last resort.
That's the role. You step in during periods of total panic or, irrational euphoria when the 95% of retail and emotional institutional players are capitulating.
Often because they're driven by that old static mindset of Civilization 2.0.
Right. That's when the 5% are executing their Civilization 3.0 conviction, buying quality assets at extreme discounts.
Okay, so the macro foundation gives you the conviction to be an owner in the first place. Now we have to shift to execution.
The how.
How does that 5% investor practically find these mispriced assets when the 95% are generating so much distracting noise? Lulu describes this as, well, rigorous investigative due diligence.
Work of a forensic detective. Or Sherlock Holmes.
Let's start with a classic example of his early style, the Timberland case study.
Yes. From around 1998. This perfectly illustrates information arbitrage, exploiting the gap between a toxic market narrative and the factual reality. And of course, the crucial concept of margin of safety.
To set the scene, the late 90s.
You've got massive tech euphoria, the dot-com bubble is inflating, and at the same time, there's just panic in non-tech stocks.
Anything that's not a .com is getting thrown out.
Exactly. And Timberland's narrative was incredibly bleak. There were headlines about lawsuits, management disputes, and fears that the brand was fading. The classic yellow boot was out of style.
All of which drove the stock price down dramatically.
So Lilu just disregards the headlines. He focuses on the quantitative disconnect. He calculates Timberland's total market capitalization at around $300 million.
But then he looks at the balance sheet.
And the tangible assets alone, the working capital, the inventory, the real estate, gave a conservative book value of roughly $240 million.
Okay, so that initial finding, that's the margin of safety right there.
That's it. Your downside was heavily protected by hard assets you could touch and sell. The profitable, iconic Timberland brand and its entire ongoing operation were essentially being acquired for $60 million or less.
Which is just absurd.
But here is the critical Sherlock Holmes step. This is what separated Lilu from every other analyst on Wall Street.
He didn't just accept the narrative about the lawsuits and bad management.
No, he knew the market was obsessed with short-term guidance. So he physically retrieved and read the voluminous court legal filings.
And in 1998, that meant tedious manual labor.
Oh, absolutely. This wasn't a quick database search. This was going to a courthouse, getting boxes of documents, and just reading for weeks.
Wait, so you're saying the difficulty of getting that information was itself part of the arbitrage?
That's a huge part of it.
The sheer laziness of the rest of Wall Street created the opportunity.
Absolutely. The arbitrage wasn't just in the numbers. It was in the effort. Wall Street analysts are incentivized to move fast, provide rapid coverage, and rely on management conference calls and headlines.
They don't have time for weeks of reading legal documents.
And what did he find? He found that the lawsuits were mostly trivial disputes, and many were actually driven by frustrated analysts who were angry that Timberland's management refused to provide short-term quarterly earnings guidance.
So management was actually acting with integrity. They were protecting long-term value against short-term noise.
But the market mistook this defiance for incompetence. They saw it as bad management.
So the market was punishing good behavior. It was mistaking non-cooperation with that 95% speculator mindset for a failing business.
You got it. And the final outcome speaks for itself. The stock rose nearly 700% as the market was eventually forced to correct its perception of the true value.
The lesson is profound then. Volatility is not risk.
It's the source of profit for those willing to do the boring forensic work of actually verifying the facts.
Okay, another deep value example. This one focusing on a pure asset play. The Hyundai department store.
Right, and this one illustrates a similar principle, but in a structurally different context. It's about finding value in global markets that have, a lot more opacity.
What was the structural anomaly there that he found?
It was corporate complexity. This is really common in some Asian corporate structures, like the Korean chaebol. Li Lu was able to identify shares where the market cap of the holding company was incredibly low.
How low?
Around $60 million. The market was essentially ignoring the underlying assets because they were just obscured by layers and layers of cross-holdings between different companies in the group.
So his forensic investigation showed what?
That the underlying real estate and the subsidiary stakes were conservatively valued at $320 million.
So that's an extreme arbitrage. You're buying $1 of verifiable value for about 19 cents.
Exactly. And this investment really highlights that market inefficiencies are often structural or informational. The hard work here wasn't just verifying the assets were real, it was successfully untangling that corporate web to confirm they were legally accessible to shareholders.
So in these cases, the book value gives you the margin of safety.
And the company's operating earnings were truly, as he put it, just the icing on the cake.
So those examples focus heavily on assets. But long-term compounding, that requires something more. It requires identifying a competitive advantage, a moat, an exceptional management quality.
The intangibles.
How does Li Lu measure those? He uses a story, the tale of two gas stations.
It's a simple, elegant parable to define a moat, even in what looks like a commodity business.
Okay, what's the setup?
You have two identical gas stations, same intersection, selling the exact same product, gasoline, at the exact same price. Yet Station A generates 400% more traffic and profit.
So what's the differentiating factor? It can't be the product or the price.
It's the owner's mindset, which translates directly into operational excellence. Station B is managed by an indifferent, salaried employee. He gets paid whether the station does well or not.
He's just punching a clock.
Right. But Station A is run by an owner-operator. He often describes this as an immigrant family living nearby who has skin in the game. Their entire livelihood is tied up in that station.
So they rush out, they wash the windshields.
They offer prompt service, they remember their customers, they treat the business as their lifeblood.
This is a perfect metaphor for the C-suite of a public company.
It is. Li Lu searches for that Station A dynamic in public companies. He's looking for managers who possess what he calls the fiduciary gene. People who treat shareholders' capital as their own, or even better, as if it's their own family's entire net worth.
And that owner-operator characteristic is an intangible quality that often determines success far more than basic financial metrics.
It's the human element that sustains the compounding machine over decades.
Now we have to highlight a crucial strategic pivot in his career, which was heavily influenced by Charlie Munger.
This is a really important evolution. His early success came from Graham's cigar butts, the Timberlands and Hyundais of the world. But he evolved to focus almost exclusively on compounders.
And the problem with those classic cigar butts, which Munger famously made fun of, is that while they're safe,
because they're protected by the balance sheet,
you have to sell them when they reach fair value. And that triggers capital gains taxes and forces you to face continuous reinvestment risk. You're always on the hunt for the next mispriced asset.
It's a lot of work.
Mm-hmm.
And the turning point for Li Lu was what he calls the cable company lesson. This was a mistake he made.
Okay, what happened?
He bought an early cable company for the statistical value of its telecom licenses. A classic asset play. He sold it when it doubled.
Which sounds like a great statistical win in the short term.
It was. But he realized he had fundamentally missed the dynamic growth potential.
Because what happened next?
The stock went up another 10 times. He had valued the licenses as static assets. He failed to grasp that those same licenses were becoming critical infrastructure for the entire Civilization 3.0 mobile internet boom.
So he was looking at the balance sheet value, the Civilization 2.0 value.
And not the dynamic compounding power, the Civilization 3.0 value.
The lesson was painful then. A great asset sold too early is a profound mistake.
A huge mistake of omission. And this shifted his modern focus entirely to finding great companies at fair prices, the compounders. These are businesses that can reinvest their capital at very high rates of return for decades.
And they can be held, ideally, indefinitely.
This is the ultimate expression of his macro thesis. By investing in compounders, he is letting the iron law of modernization, that unstoppable force of exponential growth, do all the heavy lifting for him. The strategy moves from just asset protection to maximizing your participation in the compounding upside of the modern era.
Okay, so this brings us to what he believes is the most important part.
Yeah.
Layla Liu famously states that successful investing is 99% temperament.
Right. You can have the macro conviction, you got the micro analysis, but if you lack the emotional discipline, you will fail to the point of maximum stress.
Every time.
So this section explores the philosophical underpinning that's required to build that discipline.
To structure that discipline, he relies heavily on this Neo-Confucian concept of Zixing-He.
The unity of knowledge and action. There's the philosopher Wang Yangming, and it's absolutely fundamental to his internal operating system.
Okay, what's the core principle?
The principle asserts that true knowledge isn't academic or theoretical. It is the simultaneous occurrence of knowing and acting.
So knowledge without action
is mere delusion, and action without knowledge is just recklessness.
How does that apply to an investor? I mean, we often hear people say, oh, I understand that company just because they built a perfect Excel model.
And Li Lu would argue, you don't truly understand the company at all, not until you have put significant capital on the line.
Because that's the action part.
That's the action. True knowledge is forged when the psychological pressure of potential loss tests the math and the assumptions in your model. It's that moment when your Excel model says buy, but your gut is screaming wait.
It's the execution under pressure.
Exactly. The act of executing the trade, especially when the 95% are panicking, that's what exposes every hidden flaw in your logic that a spreadsheet could never show you.
This must explain his skepticism towards sell-side research.
It does. Analysts may have the knowledge, the data, but they lack the action. There's no risk for them.
Their theoretical knowledge is often just performative.
It is. The high stakes of personal capital allocation, that gut-wrenching fear of permanent loss, that's the only crucible that develops the necessary psychological clarity. He strongly advises aspiring investors. You have to manage your own money first. That's how you develop the fiduciary gene and internalize Zixing-He.
So to make sure the knowledge part of Zixing-He is rock solid before you act, he implements this very strict test for intellectual honesty.
A standard borrowed directly from Charlie Munger. It's all about combating our natural human tendency for confirmation bias.
It demands a profound level of preparation.
It really does. An investor is not entitled to a bullish opinion, Li Lu argues, unless they can articulate the bearish case better than the smartest, most dedicated short seller on the planet.
It's a methodology of refutation, then, broken into 3 steps.
The first step is you have to find the smartest person who fundamentally disagrees with your thesis.
Step 2.
You must master their argument perfectly. You have to understand their facts, their premises, their conclusion so well that you could effectively debate your own position on their behalf. You can't just dismiss them as being wrong.
And only then, third, after truly mastering that counter-argument, can you attempt to refute their best argument with objective facts and superior data.
And if you can't complete that third step, the investment is outside your circle of competence, period.
So it transforms the entire process. It's not about seeking validation anymore.
It's about seeking refutation. Most people look for reasons to buy. Li Lu forces his team to spend the majority of their time looking for reasons not to buy.
This preservation-first mindset, it's encapsulated in a very specific heuristic he uses for his analysts. The worst-case scenario stress test.
And it focuses entirely on minimizing permanent capital loss. He doesn't ask, how much money can we make?
He asks what?
He asks, can you tell me exactly what the business will look like in the worst-case scenario 10 years from now?
That seems like an almost impossible question in a world that's changing so fast. Why 10 years?
The time horizon is critical because it forces you to think about systemic destruction, not just a short-term cyclical downturn. The reasoning is very clear. The upside is usually handled by those Civilization 3.0 tailwinds.
If the business is high quality, compounding will take care of itself.
Right. But permanent loss occurs on the downside. If you cannot predict potential technological disruptions, regulatory obsolescence, or competitive failures a decade out, you simply don't understand the dynamics of the business well enough to risk capital.
It's a complete reversal of focus then. You spend 80% of your energy on that 20% downside risk.
Because the 80% upside is already taken care of by the iron law if you chose the business correctly in the first place.
This leads to the ultimate behavioral requirement, the temperament needed to survive those inevitable 50% drops that even great companies experience.
The fiduciary gene, a term he coined.
What is the precise definition of this psychological makeup?
He defines it as an innate, almost biological revulsion to losing money, especially money that belongs to other people. It's a profound, overriding sense of responsibility that has to suppress those primal human urges for excitement or gambling.
It's the difference between the salaried manager and the owner-operator from the gas station story.
Exactly. The CEO must feel the loss of shareholder capital in their bones.
But how do you test for that gene in a CEO who has only ever known success? Success can mask a lot of flaws.
That is the challenge. And Liu looks intensely at capital allocation history. Is the manager willing to return excess cash to shareholders rather than engage in reckless empire-building acquisitions?
Does the CEO obsess over the quarterly stock price, or are they willing to endure years of criticism from Wall Street to build long-term value?
A true fiduciary will tolerate public shaming if it means protecting the future of the enterprise. A lack of the fiduciary gene often shows up as a desire for applause, which is just incompatible with the lonely, long-term work of value investing.
He also has a stern warning for you, the listener. He says most people lack this gene.
He's very clear on that.
If you are the kind of person who panics when your portfolio inevitably drops 50%, which is standard volatility for highly concentrated, high-quality investments, you should simply invest passively in index funds.
Trying to be an active manager without the fiduciary gene is just financial self-destruction.
And his own history is the ultimate test case here.
The crucible, for sure. In the first year of Himalaya Capital, 1997 to 1998, the Asian financial crisis hits, and the fund drops 19%.
That's the moment when most new managers would panic. They'd chase momentum or abandon their principles just to stop the bleeding.
But Liu did the opposite. He didn't sell anything. He viewed the drop as the practical application of zixing hay.
The psychological pressure clarified his thinking.
He did. He deepened his research, he re-verified his original Timberland and Hyundai theses, and he bought more. This demonstrates the discipline required, remaining perfectly rational when the 95% of speculators are acting like hunters whose entire world is burning down.
So Liu is perhaps most unique because he took these, universally Western-derived value principles from Graham and Munger,
Right.
and he applied them successfully to the structurally complex and often very volatile Asian markets, especially China.
And he argues directly against the idea that value investing only works in developed, institutionally efficient markets like the U.S.
How does he characterize the Chinese market?
He says it structurally resembles the U.S. market of the 1950s, which was the golden era for Benjamin Graham and Warren Buffett to find all that statistical arbitrage.
And the main factor creating that arbitrage is the structure of the market itself, retail dominance.
Absolutely. The Chinese market is heavily dominated by individual retail investors. They're prone to extreme emotional swings, high turnover, and short-term gambling. It's a 95% speculator mindset, but amplified.
And I've heard the regulatory environment is different too.
It is. It often lacks the deep short-selling infrastructure that's common in Western markets, which means there are fewer disciplined players available to police valuations when prices get way too high.
So the inefficiency isn't just behavioral, it's also structural.
It's both. The high turnover and the lack of those efficient counterforces create massive price-to-value divergences on a scale you just rarely see in the U.S. today, where algorithms often close those gaps in a nanosecond.
So for the disciplined 5% investor, this presents a long runway of opportunity.
A very long runway. While the U.S. market is highly efficient, the Chinese market is inefficient and volatile. It offers active value investors the chance to exploit the noise created by millions of retail speculators who are still operating with a Civilization 2.0 static mindset, even though they're living in a Civilization 3.0 economy.
And this feeds directly back into his big macro thesis. Liu sees China as being in an interim phase.
He calls it Civilization 2.5 to 3.0. It's making that rapid transition from an industrial society to a fully modernized, consumption and technology-driven economy.
The implication of that is massive.
It is. Because China is still catching up in areas like urbanization, domestic consumption, and service sector development, the potential underlying economic growth rate is structurally higher than in the mature U.S. economy.
It's a built-in tailwind.
It's a huge tailwind that acts as an accelerant to your returns, provided you choose the right companies.
And the iron law is paramount here.
Absolutely. As China continues to integrate globally and adopt the best practices of free market social technology, the domestic companies that dominate this transition, the great compounders like a BYD or a Tencent, will inevitably become global giants.
Driven by economies of scale and that intellectual multiplication effect.
So investing in these compounders during this volatile transitional phase is the highest form of his modernization thesis. You're betting that the mathematical superiority of compounding growth in Civilization 3.0 will ultimately overcome the short-term political and regulatory volatility.
The risk is high.
But the potential reward, riding that structural growth and the iron law at the same time, is commensurate.
It's also worth noting his caution here, though. Active selection is mandatory.
Oh, absolutely. Unlike the S&P 500, which is a pretty clean proxy for U.S. innovation, the major Chinese indices are often heavily weighted towards state-owned enterprises or older, less dynamic industries.
So just buying the index there often fails to capture the dynamism of the private sector modernization wave that Li Lu is actually focused on.
You really have to do your homework.
So given the enormous effort required for the Sherlock Holmes analysis and the temperamental rigor of the fiduciary gene, it's logical that Li Lu rejects the modern dogma of broad diversification.
Which leads to his punch card philosophy.
This is a behavioral mechanism. It asks you, the investor, to operate as if you only have 20 investment slots, a punch card for your entire lifetime.
And this constraint is a brilliant cognitive filter. If you know you only have 20 chances, you will never buy a stock on a whim or because of peer pressure.
It instantly combats so many critical cognitive biases. The action bias, that feeling you have to be doing something.
The illusion of over-diversification, where you just dilute your best ideas.
And just plain intellectual laziness.
It demands overwhelming high conviction. It necessitates that extreme margin of safety and that deep owner-level understanding of the business we talked about. You are forced to ensure you're truly buying a Station A business at a significant discount.
The result, naturally, is a highly concentrated portfolio.
He sees himself not as a manager of a basket of stock tickers, but as a partial owner of a small collection of exceptional businesses. But this concentration, it requires strict adherence to defining and respecting your circle of competence.
And Li Lu stresses that the circle is defined not just by what you know, but by what you admit you don't know.
That's maybe the most important part. Because the market is hyper-competitive, you have to specialize. You have to fish where the fish are to achieve that deep 10,000-hour understanding that's required to justify placing one of those precious 20 punches.
And that specialization is the final piece of the puzzle. The entire framework, history, analysis, temperament, and concentration, it all works together.
It allows the investor to maximize their returns by riding that inevitable wave of Civilization 3.0 while minimizing the risk of permanent loss.
So this deep dive really reveals Li Lu's investment philosophy as this truly layered and integrated system. It's not just a collection of tips.
It's a total worldview.
We've seen the three pillars that provide the ultimate structure for his conviction. First, you have the macro layer.
Right. Civilization 3.0 and the iron law. That's what justifies long-term equity holding in the first place. Because the economy is a positive-sum, compounding machine driven by physics and history.
Then second, you have the micro layer, the Sherlock Holmes due diligence. That's the execution.
Finding the mispricing through forensic analysis of balance sheets and management intent, creating that overwhelming margin of safety by exploiting the informational and structural inefficiencies created by the 95% of speculators.
And third, the behavioral layer.
Zixing in the fiduciary gene. This provides the discipline. This is what ensures the investor acts rationally, buying more, when the market is panicking, because their conviction is rooted in historical inevitability, not in fleeting sentiment.
Ultimately, Li Lu presents the value investor's role as one that's both, well, moral and highly functional.
It is. By rigorously allocating capital to the most honest and efficient Station A owner-operators, the value investor is actually accelerating the modernization process. And the iron law rewards them for this contribution with compounded wealth.
As a final provocative thought, let's go back to that evolution he had, from buying cigar butts to holding compounders indefinitely.
Right.
Consider the psychological difference between those two approaches.
This is huge.
If you had followed his Timberland analysis in 1998, you would have profited 700%. A great value play.
A home run.
But if you had instead held an equivalent compounder, say, like Amazon, from that same era, you would have had to endure far greater volatility. We're talking 50 to 70% drops over several years.
But the potential reward would have been vastly superior, truly exponential results. So the question is this: which strategy demands greater temperament? And does your own fiduciary gene truly allow you to capture those Civilization 3.0 exponential returns?
Or are you secretly still looking for the quick, safe profit of a Civilization 2.0 static mindset?
A profound question that really tests the foundation of your conviction.
It does. And remember, this entire analysis is based solely on the sources provided and is for educational insight, not investment advice. You must conduct your own due diligence.
And for those of you seeking to incorporate that essential preservation-first mindset that Lilu demands, remember the importance of knowing the market temperature. You can search and download the iOS app Buffett Indicator from the Apple App Store to track total market capitalization relative to GDP daily.
That awareness is the first step toward developing the required discipline. Thank you for joining us on the Deep Dive.
We'll see you next time.